Hello and welcome to Nomura's podcast on the Bank of England, the first rate hike in a decade, and the policy mistake market pricing. So with me today is George Buckley, our UK Chief Economist, and I'm Jordan Rochester from the Foreign Exchange Strategy side. Now, I've got George here with me today to talk through what happened yesterday, the first rate rise in over a decade. But George, the MPC have hiked, but the market reaction with the pound lower and yields lower and a flatter interest rate curve, that's the hallmarks of a policy mistake, something that the likes of which we haven't seen in market pricing since 2011, where you had many other central banks react very early on a hiking cycle in what was very troubled times indeed. So George, do you think it is a policy mistake?
I don't think it's a policy mistake. I think it's the right decision. Some people, of course, have raised questions about whether they needed to raise interest rates. I think some of the data that we've seen, some of the indicators of economic growth have been positive. Wage growth is starting to pick up. And to be honest, you don't need particularly strong economic growth these days or particularly strong wage growth in order to justify rate hikes, simply because when you've got very weak productivity, that means you can get fairly sizable increases in unit labour costs, even with normal rises in wages. And that is one of the big reasons, or one of the big risks and reasons why the Bank of England's tightened policy.
So George, I mean, if I take the framework of 2011, ECB raised rates. They raised rates twice actually before they then saw global growth and European growth nosedive, and inflation and their projections were completely wrong, and you actually saw deflationary risks present themselves at the time. So if I take that framework, that's what the market thinks the Bank of England has done yesterday. And we have the Brexit negotiations coming up, and the implications of not getting any progress in December, if I was to read the press, sounds very dire, and that's probably the growth risk that markets are probably pricing for, I guess, in the short term. And it kind of looks like the 2011 story where hiking just when growth was about to roll over. I mean, so you say that the growth story is not as bad as what some people make it out to be. But what are you watching to see if you're wrong or right on that?
Well, I think one of the important points here is that back in 2011 we had a very weak Eurozone. Of course, we had the fallout from the financial crisis. We had the Eurozone sovereign crisis just about to hit. And all of that has taken a long time to get over.
Is it Brexit a crisis?
It is a crisis, and it will mean slower growth, but it will also mean slower supply growth, and therefore it will have an inflationary impact. It's not just simply slower demand, it's also slower supply, and that's the whole point about this, that you don't need strong rates of growth in order to generate the justification for higher rates. So I do think that it's not a policy error, and I think that there will be further increases to come, not just what the market's expecting, 2 or 3, but more than that, probably 2 a year in our view.
So why does the market really not agree then?
I think what they're looking at is what the bank said yesterday, which is understandable, which is that they are arguing that they don't need more than 2 or 3 hikes in order to get inflation back towards its target.
Over 3 years.
Over 3 years. It's a long time for very few hikes, 1 a year. The market will look at that and think that's not really even a cycle. It's very limited. And that's, of course, the mantra that the Bank of England's been using, gradual and limited. But I think that when the time comes, we will start to see inflation pick up a little bit more quickly than what the Bank of England thinks. That the fall in inflation that we'll see in 2018 will be partially compensated by a pickup in domestically generated inflation, rising wage costs, and that will be the motivation for them to raise rates more quickly.
So rather than increasing inflation, people should look out for slowing inflation, but slowing inflation at a rate that's slower than what the Bank of England think, because it actually declined quite quickly from their October 3.2% peak. So what's your end game, George? You think that in Q1 inflation is going to be higher than expected, even though it will be falling, and that leads them to raise rates again?
Yes, I think the next rate hike will be sometime around the middle of next year, sometime around the May inflation report. Inflation reports are always a good bet as to when to expect a rate hike, because it allows the bank time to digest its new forecasts, and that often leads to moves in policy. So we've had a lot of discussion about the Bank of England, a key issue in the UK at the moment, and another couple of key issues are what's happening in the domestic politics and what's happening in Europe. Jordan, tell me a bit more about what's happening in domestic politics at the moment.
George, it's like trench warfare. When it comes to trading sterling, dealing with the positive Bank of England rate hike story that we had over the last couple of weeks, but also these Brexit negotiations. So you saw in the last round a very negative market reaction to the press conference between David Davis and Michel Barnier. Now, what we have seen since is the Florence speech, of course, has led to a slightly more positive undertone from the EU politicians. But you need concrete progress. You need sufficient progress to be made. And that is what the December EU summit is all about. So for the time being, next week we have the November round of negotiations. That is very key in terms of sort of delivering upon or even exceeding expectations, which is actually quite a low bar, because a lot of folks, a lot of commentary I do see, it really doesn't expect even any progress by December. So I do think that there's a positive surprise perhaps in store.
And do you think the domestic politics is having any influence on the ability of Theresa May and her government to engineer this agreement? And could we see MPs resign, for example, in the wake of these scandals, which could then make the government a little bit more difficult to run?
Well, just to touch on that scandal before we answer that question, this scandal is reminiscent of 1992, John Major's government. So Theresa May has a 13-seat majority. You need 7 by-elections. You need all of them to turn against the Conservative Party before the market questions Theresa May's ability to conduct government and also these negotiations. That's a lot of ifs. That's 7 MPs in 7 seats where they lose. And that's then a vote of no confidence where the government loses that vote. So that's a tail risk of a tail risk of a tail risk. But it's something to watch out for. But it's unlikely at this stage. In terms of their negotiations, at the beginning you had the far right of the Tory party really pushing the Brexit means Brexit, let's go for a hard Brexit. Have you looked at the polling numbers recently? You actually see the government's support from the public for the state of the negotiations in a very bad place. I think the numbers are roughly around 59 against, 24 in favour. So the public's not finding any support for the government here, and you're actually seeing public support for Brexit falling away. You've already seen a 4% swing towards Brexit's wrong. That's actually quite significant. And now you're at 52 versus 48. It needs to continue for it to really have a big impact. But I think, George, it's not yet impacting Theresa May's ability to negotiate.
And very finally, when do you think this transition agreement is going to be done and complete?
Well, I think in December you'll have sufficient progress being made, and even David Davison, his Treasury Secretary at committee, a hearing, he did say in January they'd be looking to put that more concrete detail down. But I think in December, look out for headlines about more progress and essentially some sort of guidance towards sufficient progress towards a transition deal being made.
Great, we should be looking out for those in the months ahead. Thank you very much, Jordan. If you're interested in reading any more on any of these topics, please go to our website. And also, if you want to read more on the Bank of England and the decision to raise interest rates, read our piece, Journey of 1,000 Miles, which you'll find attached to this podcast. In the meantime, thank you very much for listening.